With all of the spending we're seeing, can we really still get our clients to a 0% tax bracket? Stay tuned and find out. Is a 0% tax bracket in retirement actually possible? Explain that a little bit.
Yeah. So like I said, people think that it's not really possible to be in the 0% tax bracket unless you're poor. But the reality is there's a lot of nooks and crannies in the IRS tax code that allow for tax-free distributions in retirement. And we typically advocate strategies that call for between 4 and 6 different streams of tax-free income. I'll give you an example. We love Roth 401ks. Roth 401ks allow you to put in $20,500 per year if you're under 50. Catch-up provision gets you all the way up to $27,000. That's a tax-free vehicle. You use after-tax dollars, it grows tax-free. The Roth IRA is a tax-free vehicle. The Roth conversion is a tax-free vehicle. I talk about something in chapter 5 of my book, The Power of Zero. It's called the LIRP, the Life Insurance Retirement Plan. It mimics a lot of the tax-free benefits of the Roth IRA. That's also a tax-free retirement tool. And guess what? If you can, by way of the Roth conversion, you can skinny your IRA balance down low enough, then required minimum distributions can be offset by your standard deduction, in which case your IRA distributions will be tax-free. And if you can keep your provisional income low enough, and provisional income, by the way, is the income the IRS tracks to determine if they're going to tax your Social Security. If you can keep that low enough, then your Social Security can be tax-free. So that's 6 different streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket.
There are tens of thousands, hundreds of thousands, a million plus advisors that have a life insurance license in the United States. Why is it that many are not talking to their clients about this? Are they just unaware of the impact of future taxes? What are you saying? Or what would you say to advisors that maybe are saying, well, it's not going to be that bad? And how do you help kind of bring them along?
Well, that's one of the motivations behind why we created the documentary that we filmed in 2018, which is called The Power of Zero, the Tax Train is Coming. And during that documentary, filmmaker Doug Orchard and I crisscrossed the country interviewing the most important experts in the nation on the national debt as it relates to the future of tax rates. We interviewed Ed Slott, we interviewed Tom Hegna, we interviewed the governor of Utah, we interviewed George Shultz, former Secretary of State, we interviewed Dr. Kotlikoff, we interviewed David Walker, we interviewed Maya McGinnis, president of the Committee for Responsible Federal Budget. All of these experts are reading the same music and they're singing the same song. They're saying that if we don't change courses as a country immediately, that 10 years from now, tax rates will have to double or we go broke as a country. So don't take my word for it. Take the word of these experts who study this stuff for a living. These people are saying that you've got to get your fiscal house in order personally, or you're going to be giving away half of your IRAs or 401ks to the IRS if you retire past 2030. So I would say there's a lot of resources out there that people can utilize to educate themselves. But look at what the third-party experts are saying, because that's the most convincing evidence of all.
What are some of the pitfalls people run into when trying to get to the 0% tax bracket in retirement?
There's a lot of pitfalls, Don. In fact, I'm writing a book full of all of the pitfalls that people run into. And one of the things that I love to talk about are pitfalls that advisors run into. And one of the biggest pitfalls of all is this tendency to make the LIRP out to be this silver bullet, this panacea, if you will, this Swiss Army knife that solves all of your problems. The LIRP, the Life Insurance Retirement Plan, has a lot of compelling attributes. It doesn't have no contribution limits, no income limitations, has a death benefit that doubles as long-term care, which is very important. But it should always be used as a complement, one of multiple streams of tax-free income retirement, not the only stream. So I would say one of the pitfalls that you got to watch out for is if you're dealing with a financial advisor who is holding out the LIRP as the only stream of tax-free income you should be embracing in retirement, that is not someone who is well acquainted with the Power of Zero paradigm and well acquainted with a comprehensive and balanced approach to tax-free retirement. So that's one of the big pitfalls, is you just want to make sure you have multiple streams of tax-free income none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket.
David, you have a training program for financial advisors to learn about this. Can you talk a little bit about that?
Sure, we have not only do we have a training program, we have a marketing program as well. So basically, the goal of that training program is to turn you into David McKnight after about 6 months, only without the 7 kids. So if they want to learn how to have the 7 kids, I can teach them how to do that too. But the point is, I have a number of scripts, and I'm a financial advisor. I've been a financial advisor for the last 23 years. I'm a multi-year top of the table qualifier. So it's not like I'm speaking about all this stuff from theory. I've been in the trenches, and I understand exactly how clients operate and exactly what the hot buttons are that you got to press to be able to shepherd these people through the sales process. But we have a sales or a sales training process is designed to turn you into me after about 6 months. And then we have a turnkey marketing program that puts you in a position where you have a consistent stream of new prospects that are anxious to adopt the Power Zero paradigm, so that you wake up January 1st and you never have to worry about prospecting ever again. So that's a pretty powerful combination, right training, right marketing. And that's something we've been doing for about 10 years now here at the Power Zero.
If you had one piece of advice you'd give the American investor, what would it be?
I guess the one piece of advice, at least from a tax perspective, would be to recognize that no matter how much you dislike paying taxes, that today we are in the midst of the tax sale of a lifetime, meaning that taxes in the future will never be as low as they are today. In fact, I was interviewing David Walker, former Comptroller General of the federal government, about a year ago on my podcast. And he was saying, Dave, you can take this to the bank. Tax rates in the future will never, ever, ever be as low as they are today. And so people that are trying to figure out whether they should invest tax deferred or tax free should really take that warning to heart, meaning that if you're contemplating whether to pay taxes on your money now while tax rates are historically low, or postpone the payment of those taxes till some point further down the road, they should really, really consider what's happening between now and 2026. Namely, that we have historically low tax rates that are slated to revert back to what they were in 2017. And that we should be taking advantage of the next 4 years of low tax rates, because every year that goes by where we fail to take advantage of historically low tax rates is potentially a year beyond 2026 when we could be forced to pay the highest tax rates we're likely to see in our lifetime. So let's not procrastinate. Let's take advantage of every single tax year, because every little bit counts. And if you don't shift money to tax-free this year, then you only have 3 years in which to pay those taxes. And the likelihood that you'll bump up into a tax bracket that gives you heartburn increases dramatically. So just take advantage of every year of historically low tax rates. And when you take that money out down the road, you'll be glad that you did.
Longevity risk is the risk of living too long and perhaps running out of money. And that is the top concern of retirees. How can Americans mitigate that risk while at the same time protecting from higher taxes?
Well, that's a really good question. And it's something I think that our industry really struggles with, because there's financial advisors out there that are really good at mitigating longevity risk. They do that typically by way of an annuity. And there's advisors out there that are really good at doing mitigating tax rate risk. And they do that by way of a complement of tax-free investments, Roth IRAs, Roth conversions, Roth 401ks, LIRPs, so on and so forth. But there are very, very few financial advisors who are adept at mitigating both of those risks within the very same financial plan. Don, if you think about it, how often does an advisor who recommends an annuity recommend that the client implement that annuity within the tax-deferred bucket? You have an IRA, let's roll it into an annuity and let's keep it in your tax-deferred bucket forever. Well, there's a problem with that, because you're still in that business partnership with the IRS. And as tax rates go up, your portion of that IRA goes down. Not only that, but when you take distributions from your IRA, it counts as provisional income, increases the likelihood that your Social Security is going to be taxed. Those two things alone, the possibility of rising taxes and Social Security taxation, could force you to run out of money 5 to 7 years faster than you ever thought possible. What I prefer is an annuity that has what we call a piecemeal internal Roth conversion feature. In other words, it's an annuity that allows you to begin by putting the money in the IRA, and then you systematically, and it has a feature whereby you can systematically Roth convert that money to the tax-free bucket in an amount of your choosing over a time period of your choosing, such that by the time you elect that guaranteed lifetime income, you can do it in the tax-free bucket. You take that money out tax-free, you're shielded from tax rate risk, and you're also, when money comes out of the tax-free bucket, it doesn't count as provisional income, does not cause Social Security taxation. So you're shielding yourself from both of those risks. And so what you're effectively doing is you're solving two risks within the very same financial plan. You're shielding yourself from longevity risk because you have guaranteed lifetime income, and you're shielding yourself from tax rate risk because you're doing it within a Roth IRA.
Do all annuities allow this?
No, in fact, very few annuities. Every annuity allows for a Roth conversion, but they typically say, we'll let you do the Roth conversion, but you got to do it all in 1 year. So you get $1 million in your annuity. You can convert it to a Roth IRA, but you got to convert it all in 1 year, which means you're paying tax on all $1 million all in 1 year. That's going to kill you from a tax perspective. In an effort to avoid a doubling of tax rates over time, you doubled your tax rate in the short term. That's not very effective planning. So there's 4 or 5 annuity companies out there that allow for this piecemeal internal Roth conversion. And so we just recommend that people make sure when they're talking to their financial advisors that they're clear that that's a provision that's noted within the annuity contract, so that they're not stuck inside that annuity with only the lump sum Roth conversion alternative.
Hey folks, this is Don Grays. I've been with David McKnight, and we had a fantastic time. David, thank you again for being my guest.
It was my pleasure. Thanks for having me.